These economic indicators are more important than the CPI, the inflation. It's called the PCE, or the Personal Consumption Expenditure, also known as consumer spending. This measures the spending on goods and services of regular people. Now, this can be a dangerous number if going in the wrong direction. And there's even a hidden warning here, so make sure to stick around till the end of the video. Also, it's very important since it has a lot to do with America's GDP. The latest readings have been released. The question is if we should worry about the numbers or not. So stay with me for the next few minutes as we dive into these numbers. Let's find out what the heck they are and what the heck they even mean. Now, according to the latest readings, the PCE price index was at 2.7% on an annual basis and at 0.3% up from the previous month, which are all pretty much in line with forecasts, so nothing too crazy there. On the other hand, the gross domestic product, or GDP, rose by 1.3% annualized rate in the first quarter of 2024. So it is still positive. That's a good thing, but it is slowing down. But what the heck's all this stuff mean anyway? Well, to understand things a little bit better, I think we need to first define and dive into a little bit more what PCE is, or the PCE Price Index, or the PCEPI. They are two closely related economic indicators. Both are released monthly by the Bureau of Economic Analysis, or the BEA, a division of the U.S. Department of Commerce. Now, that is an organization that is responsible for the analysis and reporting of all of this nerdy economic data. These reports influence decisions made, of course, then by the government and by the private sector as well, which include taxation and interest rates, two very, very important things, obviously, for investors and really basically everybody. Now, this PCE is a measure of total consumer spending in the economy. It includes spending on durable goods like cars, and also non-durable goods like food and services, haircuts, for example. Basically, it tracks how much money people are actually spending out there in the real world in the economy. Fun fact, by the way, consumer spending is the biggest driver of the US economy. In the first quarter of 2024, personal consumption expenditures represented nearly 68% of the nation's GDP. So it's safe to say it is the one keeping the economy afloat, and definitely something to pay attention to. On the other hand, PCEPI is a measure of inflation based on PCE. It tracks how the prices of all those goods and services consumers are actually out there buying, how they change over time. So it tells you how much more expensive that basket of things that people are buying, that they're consuming, is actually getting. But we already have the CPI. Why do we need yet another three-letter indicator? Well, what's the difference? Well, for one, the CPI tracks the average price of change of a fixed basket of goods and services, the typical consumer purchases. Think of it like a grocery list that essentially reflects the common spending of the common man and is only updated every few years. Now, this list, of course, does not change that often, thus kind of providing a pretty good baseline over time for tracking how price changes happen throughout a period of years. However, it does have a weakness. It can miss out on how consumers actually are adapting to inflation, which is a very, very important thing to discuss. For example, if the price of bread goes up, the CPI might not capture a shift towards buying more rice, for example. This is where the PCE price index actually shines, because it actually offers a much broader perspective on what people are actually buying in the real economy. It tracks the prices of all goods and all services being consumed by all individuals. The formula it uses is a much more flexible one, and it takes into account substitutions like rice for bread. Now, this means it can better reflect how consumers might actually switch to cheaper alternatives when prices are rising, aka how much consumers might even be suffering in the current economy. This gives economic analysts and policy makers more accurate data, since it reflects the most recent spending patterns of people in the economy. Now, unlike the CPI, which relies on data from a few years back, right? This allows the PCI to capture changes in consumer behavior. Now, we have a better understanding of what the PCE is and the PCE Price Index. Let's take a look at the latest GDP readings. This is an important thing to consider here as well. And don't worry, we'll tie it all up at the end of the video, how it's all related, why all this is important to be thinking about. The latest report shows that the GDP rose at an annual rate of 1.3% in the first 3 months of the year. Don't bring out the champagne just yet, guys, because this is lower than the previous 1.6% estimate that came out from the Bureau of Economic Analysis. This is significantly lower than the previous quarter's 3.4% growth. This means that the US economy is still in the green. Thumbs up for that. But it's losing momentum. No bueno. Still growing, but we have to take into consideration that the ideal GDP growth rate is between 2 to 3%. We're under that. So you don't want to be too hot. You don't want to be too cold, right? 2 to 3%, the sweet spot. And I know what you're thinking. The higher the number should be better, right? Well, if it gets too high, then the economy grows too fast. This can lead to higher inflation, asset bubbles, all that kind of stuff. The Fed doesn't really want that to happen either. And for those who have seen the last housing bubble of 2008, you will know that a bubble bursting is not a pretty sight to behold. So tell you what, if we get enough likes in this video, perhaps we're going to have to consider making a video on how to spot an asset bubble before it pops. Well, there's a good idea. Now, on the other side of the spectrum, you don't want the GDP numbers to be too low. Obviously, a low, prolonged period or a negative GDP period signals a problem to the economy. In fact, 2 quarters of negative GDP growth is actually a recession. Technically, they don't count like that anymore, but technically it is. So if you don't address the problems, you end up in a recession. Now, before we move on to the next part of this, I just want to interrupt the flow real quick to let you know the best damn newsletter in the cryptocurrency industry. It's my newsletter. It's called Wealth Mastery. Every single week, we're bringing you the latest, the greatest, the best money-making insights on everything happening in the crypto space. Meme coins, airdrops, altcoin news, deep dives, NFTs, charts, technical analysis, and much, much more. You can join our 125,000 plus weekly readers for free and sign up using the link in the description or the pinned comment over on X. Now back to the regular scheduled programming. So now that we know how the PCE, the PCEPI, and the GDP actually work, we can look at the numbers more objectively. Just to refresh, the PCE price index rose by 2.7% on an annual basis and by 0.3% from the previous month. And these numbers are pretty much in line with expectations from major analysts. This means that prices of goods and services are still rising, which is not fantastic, though not beyond what was kind of expected. So, silver lining, I guess. So, this is good or bad, of course, depending on your views about inflation. Generally, you want inflation to come down. Consumers have more money to spend, more money to ape into your newest dog coins, all that kind of stuff. The good news is it seems like people are still pretty confident in their spending power since expenditures have not really declined all that much. People are still spending pretty heavily. The GDP, on the other hand, is lower than the previous quarter and below the ideal 2 to 3% growth rate. So what does this mean for investors? Well, it all boils down to what the Fed is actually going to do with all that data. Right? They look at this and try to decide what to do. You see, we're all waiting, of course, for the Fed to lower interest rates. That's the big signal in the market. It's simple. Lower rates are going to end up meaning more money for investment. Companies can refinance, buy more stuff. People can refinance, buy more stuff, more houses, blah, 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 blah. Low rates will make borrowing cheap. Thus, investors will be encouraged to borrow to either expand their business, invest in assets like stocks or houses or dog coins. Dogcoin assets, my favorite stuff, right? Based on the numbers, inflation seems to be relatively under control. Hopefully, at least not too wildly high at the moment, so that's good. However, the GDP is also tapering, which is bad. If it slides further, it could be very bad for the economy. That's the hidden warning there for you. GDP is going in the wrong direction, inflation kind of under control. But here's where it gets exciting for you. If inflation is under control, then the Fed will have fewer reasons to keep interest rates high. So they have to cut. And they also need to lower the rates, of course, if they want to stimulate the economy to get people buying and borrowing again. This anticipated rate cut could potentially start the real final crazy phase in the market at the big run up, the wild times when all your dog coins go to millions, aka the end of the bull run before the big crash, because at some point you have to pay the piper. But can you hear the money printers warming up? There's a lot of crazy to happen between now and paying the piper. Okay, so last round has not been called yet. Okay, still plenty of time to order drinks. Ape into your favorite dog coins. Good luck. Thanks for watching.